Hi, everyone, and welcome to the first quarter capital market review. The data we'll talk about is through the end of March. It's been a really volatile quarter. There was an awful lot of high hope at the end of last year with respect to the market continuing its unprecedented growth, in spite of some concerns about the Trump administration's tariffs, as well as a visually weakening economy. So we're going to talk a little bit about where we are today, where the economy is, and so forth. As we typically do every quarter, we identify a theme, and I've been doing that lately by using song titles. So looking at the end of last year and the excitement that we had, and analysts continued to increase stock market valuations and price valuations right through the end of the year, I reflect back on a song from 1987, the Ramones, Bop Till You Drop. And that's kind of what we've been having. The market's been bopping along as it typically does through recessionary periods. Market goes higher, data goes lower, until at some point we see a drop. And there was a famous lyric from the song, no matter what, you just can't stop. And that's kind of the momentum that we've had with respect to the market. Things are beginning to change a bit. We'll see what that means. We'll see what impact it's had on the market so far this year, at least through the first quarter. We do these in an attempt to kind of give you a better idea of where we think we are, and more importantly, where we're heading. If you allocate as a result of economic data and not just momentum, what's working now, you have to take into consideration a couple of things. One, where we are in the economic cycle, and that's somewhat difficult to do because these cycles can be elongated. The runway can be a whole lot longer than we anticipate. And as many of you are aware, I've been somewhat concerned about the economic data for better part of 2 years. And it's taking a long time to see this economy kind of do its ebb and flow. And then the other thing is where the Fed is. Are they hawkish? Are they dovish? Liquidity is a huge impact on markets. Our agenda today is broken up into 4 elements. We'll spend a lot of time on the economy, talking specifically about current components, that is snapshots of where the economy is presently. I'll provide some dialogue with respect to that and what effect or impact some of these current issues may have, such as tariffs and immigration. And then we'll talk about some of the macro data. I won't spend a lot of time on that. We'll touch on a couple of the larger macro slides. And then we'll talk about markets, specifically valuations. How did that first quarter shake out? Have we seen a change, maybe in momentum or a change in leadership? And then where do we go from here? Not specific transactions, but sort of at 30,000 feet as it relates to many of your IRAs. What adjustments, tactical adjustments, are we looking at making? Have we made so far? And why generally, again, at 30,000 feet, are we making these kinds of adjustments? For, again, better part of 2 years, I've been saying, look, if we're watching the data, eventually we're going to get an answer. And there are several outcomes that we would anticipate. One, being that the data continues to show weakness until we see a drop. And that's typically what has happened in the past. We saw that in 87, Black Monday. We saw that in 01. We saw that during the financial crisis. Data continued to weaken, market continued to go higher until we saw a sizable drop. And then a lot of that gain was eroded in the matter of just simply a few months. Or we might see the data shows continual improvement, in which case this narrative of a soft landing may actually hold up. In either case, I was hoping to see some broadening out where other market segments start to perform beyond simply the Magnificent Seven. A period of time similar to where we were in, let's say, the dot-com bubble, where the market got a lot of its strength, a lot of its momentum from really a handful of stocks, certainly a very small handful of segments. So we should see this better participation throughout. That would be both from the standpoint of upside, but also downside. Are there other areas that potentially are holding value a bit better? So we'll look at that as well. Let's start. The economy and current components. Let's look at GDP, the component of GDP. The last several years, GDP has been really quite robust. Digging in a bit, peeling back the skin of the onion, we can certainly see why. A lot of the improvement that we've seen the last several years has come directly as a result of robust consumer consumption. That's 70% of our economy. And the consumption rate that we've seen is certainly far higher than the long-term norm that has been established over many, many, many years. Additionally, government spending has been 2 or 3x the average, again, over the long term. And both of those things have contributed to higher GDP growth. Now, that said, we just recently, within the last week, got data on consumer confidence, and it hit the lowest mark we've seen in many years now. And you're beginning to see consumers somewhat roll over. And there's some concerns with the overhang of tariffs, et cetera. Will consumers moderate? Will they pull back? We're seeing some of that. We're also seeing, as you'll see in a moment, credit card default rates, those things rise, which are typically indicative of some consumer weakness. So the expectation is GDP will start to come down, and on a percentage basis, a fair amount from what we've seen the last couple of years. That's certainly the expectation for this quarter, first quarter that is yet to be reported out, and then also second quarter. In addition to GDP, what's been in the news for many years now has been inflation. It peaked in June of 2022. Fed started cutting rates in March of 2022. And we've seen a sizable drop in the inflation rate. However, the last 2 years or nearly 2 years, inflation has been somewhat sticky, somewhat flattish. We're certainly not seeing the decrease that we saw before. More importantly is if we look at this chart and see kind of where inflation is today, and then look at the y-axis and kind of get a reference point as to where a 2% inflation rate is, we've got a long way to go before we get down there. Now, the big concern is these tariffs. And we got a lot of news just this past Wednesday on tariffs. Those things have a tendency to be somewhat inflationary. And to the point where JP Morgan has mentioned in commentary that they would expect the inflation rate to track a whole lot closer to 3% or more by the end of the year. That becomes problematic for the Fed because it takes away some of the tools they would use to fight a slowing or sluggish economy. Tariffs are in the news. Tariff rates have been relatively low for the past many decades. We saw a spike during the first Trump administration. And now, as of, well, this slide actually was data through March 31st. That was before Wednesday. In the aggregate, the level of tariffs is a bit higher as of Wednesday than they were at the beginning of the quarter. Reality is a bit different than expectation. And that can create some issues for the economy. Tariffs maintained, the cost rate maintained by corporations will certainly reduce profit margins. The tariffs passed through may very well cause higher inflation. In both cases, may very well cause consumers to change their spending habits, may even reduce some degree of demand. The hope is that it forces corporations to reposition manufacturing here, which will certainly help employment. However, if the tariff rates cause a neutralization in tariffs across the board, so effectively tariffs come down, they go to zero because a 25% tariff here is being met with a 25% tariff there. This is crazy, guys. Let's take it down. Then that disincentivizes folks from repositioning factories and hiring employees here. You're not doing it necessarily to create cheaper goods because the tariffs are effectively nil. It then becomes, our labor rates cheaper elsewhere, and you might very well still see foreign influence over U.S. imports. Looking at labor, part of the reason that consumers have been so strong is we've seen a labor rate that has certainly been increasing here recently at a higher rate than inflation. The problem going forward is if we really crack down on immigration, that is either exporting current illegal immigrants or reducing substantially the level of immigration we have presently, that may very well affect labor force. If you look at the lower chart on the right-hand side, you'll see that dark gray or black, that represents total labor force. And you'll see the last several years, it's been somewhat flattish to slightly downward. Part of that is the aging baby boom population retiring out. Part of that is also somewhat of a reduction in population as well. The only thing supporting it, the only thing that has helped it from being even weaker still, has been a lot of the immigration, legal or otherwise. If you look at the chart right above it, it talks about the year-over-year change in labor force growth. And you'll see that as of recently, the most recent data, blue representing foreign-born workers, dark gray native U.S.-born workers, you'll see that actually most of the growth, a slight majority of growth, has been foreign-born. So if that number comes down substantially, it could really have an effect on labor force, which might cause labor rates to rise as well. The expectation is these tariffs will help close the deficit, and everything will be terrific. We've got a bit of a problem. Right now, the government spends $7 trillion a year. That's total spending. If you look at non-military discretionary spending, that only represents about 12% or so of the budget. So there's not a lot that can be done there. If you look at total government spending as it relates to government employees, only about 6% of government spending is directly related to federal employment. So cutting and reducing federal employment certainly helps, but it's not going to plug the gap. And right now, our deficit is 27% of our budget. And if you look at the left-hand slide, the second stack, you'll see reference there tariffs representing only about 1%. Tariffs, which as of last year represented about 2.4% of total goods and services. I'm talking about the increase in pricing. The current tariffs as set by Wednesday's Rose Garden announcement, now 6-ish%. So there's been almost not quite a tripling of tariff relative to cost with regard to goods and services, not going to close the gap. Big problem is if we get the tax cut, that is an extension of the tax cut, that can be deemed somewhat stimulative. If we get a reduction in taxes on Social Security and overtime, that will be stimulative. But at the same time, it'll blow out the deficit. And right now, deficit spending is significant. It's nearly $2 trillion. And interest rates are not going down, which makes the cost of government spending really impactful and not necessarily in a great way. If you look at interest rates and where the Fed is on that, the Fed right now, if you look at the dot map, the dot plot, which are all those little dots toward the far right-hand side, some are FOMC dots, some are market expectation dots. The market is anticipating about 3 rate cuts this year. It's really more bifurcated. If we have a higher persistent degree of inflation, that becomes more like 1 or 2 rate cuts at best. If we see a real reduction in economic growth or a decrease in economic consumption and size, that might be something north of 3 rate cuts. And that's one of the reasons that you're seeing bond values rise as interest rates are dropping. The other thing that's somewhat interesting with respect to that is you're also seeing the yield curve ascending. So longer term rates are holding their rate value more so than short term rates. Looking at macro data, this is much of the stuff that we've talked about in the past. I won't go through a lot of it, but the LEI, the leading economic index that we've been tracking for 3+ years, continues to drop. It dropped again. Most recent data was released the end of March, dropped 0.3%. It's been dropping pretty consistently. Again, in line with what would anticipate being at some point some type of a recession. Even a mild recession or a soft landing can have effects on a highly valued market, but the macro data still isn't great. Certainly isn't what you'd expect to see if the base case is soft landing. Looking at some of the more highly frequent data, credit card delinquencies, those are those who are 90 days late. We're now at something like 11.35%. That's approximately 1 out of every 9 credit cards are 3 months late or more. That's up from 9% or so just a year ago. Highest level recorded, and certainly much higher than long-term rate. And again, this is in an environment where things are still fairly fine. Commercial mortgages, think of that as mortgages on office buildings, are hovering around 10%. Not the peak that was hit at the end of last year, but this year there is something like $800 billion of mortgages that are terming out that need to be refinanced, and next year nearly the same. So between now and next year, there's something like $1.7 trillion of these mortgages that are terming out at much, much higher rates. Also, because the occupancy rates are still very low, these buildings are also worth a whole lot less than they were worth 5 years ago when the bank last negotiated with the building owner. So there are many situations out there where a $50 million building that was carrying a $40 million loan when everybody was working and the loan was 3%. Today, the building is half leased The building is now worth 26 million. They've got a $38 million mortgage still on it because they've only been making interest payments because they've had less cash flow coming in, and it just can't get financed. And that's why you're seeing these elevated rates. 2 years ago, the default rate on these mortgages were 1-ish%. It was a 1% handle. Manufacturing has been weak for a while, continues to be. Not everywhere. Chicago showed a slight uptick to 45.5 by their metric. That's in contraction territory, anything sub 50, and they've been there for months and months on end. 15 months, I think, consecutively in a row. Philly, the ISM numbers all are showing continued weakness. Again, not what you'd expect in a soft landing scenario, at least not yet. From a valuation point of view, the quarter was a bit difficult. All the broad-based indices were effectively down. The S&P was down 4. Equally weight was only down less than 0.5%, or less than 1 full percent. Again, showing kind of a broadening out. The NASDAQ was down over 8. The composite was down over 10. The Magnificent Seven was down even more. So you're beginning to see a bit of a broadening out. The Dow Jones Industrial Average was down less than 1. Conversely, value stocks that have lagged way behind were up 2. International markets that have been essentially dead in the water for several years were up 8-ish and are holding their value fairly well. And bonds, which have had a very, very difficult 3-year period, are now getting a bit of a bid. They were also up and continue to be. Gold, which generally is a safe haven in times of uncertainty, up over 17%. And any way you want to look at it, a balanced fund, US specific or global, all down as well. So what is bringing this weakness to the S&P, the NASDAQ, and a lot of the growth-oriented elements of the market? Well, the Mag 7 are having some difficulty. If you look at the Magnificent Seven and look at what they're down for the quarter, Apple down nearly 9, Amazon 14, Google 18, Tesla 31. Remember Tesla? November, I believe it was up 60% after the election. It's given a lot of that back. Microsoft, NVIDIA also down. So on a weighted basis, those 7 contributed a minus 4.2% of the S&P's 4.3% return, or about 96% of it. Still quite concentrated as to what's causing the S&P to move, but clearly other elements of the market are starting to perform. This concentration we've had in the Mag 7 creates some real issues with valuations. This chart shows the S&P at inflection points. You'll see that we've had a little bit of a dip here this quarter. That represents that 4-ish% drop. But you'll see even with that, we're at a PE that's forward of 20.2. Historically, the P's are typically 16. Valuations, in spite of the drop, are still really high. And if you look at the box within the chart, and let's compare the second set of data to the last column of data, that would be representing the market as we saw it on March 9th of 2007. By the way, that was the peak going into 2008, which we saw a really big drop in the market late in 2008 into 2009. That was the financial crisis. But at the peak, we were at 1,500 on the S&P. Today, we're 5,600. We were at 15 times PE versus 20 today. So the market, in spite of a little bit of a drop, is still 20+% richer than it was at the peak before the financial crisis. Dividend yields were higher then than now, implying higher valuation today. And the treasury yield was actually higher then. So there was, more places effectively to go, but the delta between the two isn't significant. We're at 4.2% on the treasury versus 4.7. So this concentration is really affecting valuations. And if you were to look at the valuation presently against kind of a 30-year long-term average, just about any which way you want to shape it, things are still really quite expensive. P's are much higher. The cyclically adjusted P, or the Shiller P, is quite a bit higher. Dividend yields are actually lower, which would imply higher valuation. Price to book, quite a bit higher. Price to cash flow, significantly higher. And the earnings yield spread, which is the inversion of S&P earnings to the S&P, actually it's a negative number. Really problematic. Valuations are so high. Reason? It's concentration risk. That first chart to the left dissects the market, taking a look at the top 10 stocks versus the S&P, which is dark black, versus the remaining 490 stocks. And you'll see that PEs are much lower when you get away from the top 10. But the top 10 contributed a good deal of those earnings. Now, going back in time, you'll see that the valuations today are really quite stretched. Those top 10 names today represent, well, we'll see that in a second, represent about 40% of the market value. And you'll see that the weight of the top 10, this would be the right-hand upper chart, represent about 36% today. It was 40% or thereabouts, close to at the end of the year. And back 25 years ago, before the dot-com bubble, that number was in the 20s. So the concentration risk, 40% of the index today versus 20-ish% at the prior bubble peak, which was the dot-com bubble, again, becomes a bit of a problem. And we'll see that as well when we look at relative performance. You'll see here this quarter, you've noticed the Mag 7 dropping a whole lot more, which is then subsequently driving the S&P down even lower. But when you look at the blue line, I'm talking about the left-hand side of this, you'll see that it's dropped, but on a relative basis, quite a bit less. Another way of sharing the same data is that Buffett indicator that I shared with you back in December at the end of the fourth quarter. It was, I think, 208, the highest ever recorded as of and by the way, that data back in December would have been as of September. This data that I'm showing you today is actually as of December 31st, end of the year, 211%, which is about 67% higher than the long-term trend line. Again, as high as ever recorded. Warren Buffett looks at this index, which currently is at 211%. You would think the market is fairly priced at about 50, 60%. It becomes expensive at 100, becomes ridiculously expensive. There have been many of our articles written here recently. You may have read some regarding Warren Buffett's raising of cash levels. He's taken his portfolio down significantly. I don't know the exact number. It's somewhere between 300 and 500 billion dollars in cash, highest ever that he's sitting on, because these valuations are crazy. And you'll see the drop. And by the way, this is the ratio, total stock market value to GDP. Numerator reflects the value or price that the market is putting on forward-looking productivity of those companies, whereas the bottom number, GDP, is actually the sum total of all goods and services created and produced and consumed in the US. It is current productivity. It's not a true ratio, as I said before, because the denominator, GDP, has a number of inputs. They're not all publicly traded. My little company here contributes to GDP. We're reflected in the bottom number, but not the top number because we're not publicly traded. Think of universities or large partnerships, law firms, accounting firms. Think of University of Michigan Healthcare. I don't know how many tens of thousands of people they employ or how many billions of dollars they contribute. Totally in the bottom number, but not in the top. So we're really stretched out. And the drop that you see after every one of these peaks is the drop in that ratio. So the heavy lifting is being done on stock market valuations coming down quite a bit. Remember, if this was a recession, and there were recessions in there, the ratio may very well go up because the denominator, the bottom number, would actually be going down as GDP gets lowered. The ratio would actually increase as opposed to go down. So it's a bit of a problem. We're marrying now economic caution with market valuation caution. And whenever that happens, as we've seen the last several days with volatility, it doesn't take much to rattle the cage. So where do we go from here? Again, at 30,000 feet, there are some things that generally work and work pretty well. Fixed income, which is maybe 20% or so of our portfolio, maybe a little bit higher if it wasn't for our cash positions, generally go up when the market goes down. Should the Fed actually cut rates a couple of times, that should be proactive and positive for the market. It's also generally a safe haven, not only here, but worldwide. So this tariff talk will also affect economies elsewhere, and people tend to store wealth in areas that they feel they can get their hands on at some point, and US dollar denominated treasuries tend to work well. So not only will they move, interest rates go down, values go up because of Fed action, it can also happen with respect to demand as well. International securities have been really off everyone's radar screen for quite a while. But if you look at year-to-date numbers, that second set of columns, that would be in US dollars. So if you're an American buying in US dollars a foreign fund or a foreign ETF, you generally get a bump in your performance because the dollar is generally falling here. So it's a hedge on the dollar. If you look at the first column, let's look at EFI, which is about the third from the top. It was up 3% year to date, but a US-based international fund would have been up closer to 7%. Big delta. And as a result, this weakness and talk can very well have an effect on foreign securities. Also, international valuations compared to US valuations are really stretched and quite cheap. In fact, as of December, it was the lowest ever recorded. As of March, it's still nearly as low as we've ever seen. The spread between valuations are over 33%. I've always been kind of a mean reversion kind of guy. Eventually, that closes up. And then the last area that also tends to offer little correlation and some hedging is what I would call the international or alternative space. Gold, silver, which we have, real estate somewhat, but I'd have to be very select. I wouldn't want to own office buildings for the obvious reasons we've spoken about. But then other things as well, venture capital, private equity, etc. This chart, which isn't complete, it doesn't show precious metals, it doesn't show some of the other areas, but it gives you a general sense. If you look at that kind of yellow and blue circle to the far right, that's a 60-40 traditional portfolio, stocks and bonds. And you'll see its 10-year annualized return rate. That's the y-axis. And you'll see its trailing 10-year correlation. It's obviously 1-to-1 against itself, but everything else on that chart is to its right. And in some cases, actually yielding greater return, but far less correlation. So as a result, it becomes somewhat a diversifier, both in terms of return, but more importantly, in terms of risk. So there you have it, folks. That's the review as of the first quarter. There were quite a few fireworks. Those fireworks remain. We would expect to see more of that as we carry on through the next several months. If you have any questions about this or anything else regarding your accounts or portfolio or markets in general, by all means, give us a call or reach out to us via our web email address. With that, I want to thank you. Have a wonderful upcoming Easter season, spring season, and we will talk to you again at the end of next month, but a much deeper dive at the end of the second quarter. Thank you very much. Talk to you soon.